Good morning, ladies and gentlemen. Welcome to the JPMorgan UK Smaller Companies Investment Trust Investor Presentation. This presentation is being hosted on Research Tree by Doceo and Capital Access Group. During this recorded session, investors will be in listen-only mode. We encourage you to submit questions, which you can do at any time via the Q&A tab at the right-hand corner of your screen. Just type in the question and press send. There will be a short survey at the end, so please stay on the line at the end of the call. While presenters may not respond to every question during this meeting itself, they will review all questions and, where appropriate, publish responses. You will find these responses on the event page on Research Tree. So, without further ado, I'd like to hand you over to Georgina Britton and Ketan Patel.
Good morning, everyone, and lovely to so-called be here. So obviously, Ketan and I are going to talk you through this presentation on the JPMorgan UK Smaller Companies Trust. And I'm going to start and then hand over to Ketan, who will take you through the sort of details within the fund. But first of all, in the modern world and here now today in 2023, you have to start with the economic outlook. Ketan and I are bottom-up stock pickers. That's what we look at. That's what we buy into. That's what we hold. But as I say, in 2023, you have to look at the economic outlook. It's incredibly easy to get extremely gloomy about the UK, especially sort of after reading most of the Sunday newspapers. But actually, the message is not all bad. These are four of the charts that we focus on to a very large extent. And I'm going to start top left with the UK GfK consumer confidence. And actually, these figures, we didn't update them because we'd already sent out this pack, but we got new figures last week. And I think the one that really surprised us was people's confidence in their own personal financial situation for the next 12 months has risen to only -1. I mean, you can see going back to 2014, in general, people are -1 is not unusual. And actually, if you think of everything that's going on, and in particular the inflation figures, interest rates, etc., I think that was definitely a big surprise and a very positive one. So the consumer appears to be extraordinarily resilient in the face of the economic backdrop. And why is that? Well, I think the two obvious reasons, one we don't have on this chart. So unemployment, as you'll all be aware, is extremely low and actually surprised being sort of lower than expected, the most recent data. So people have jobs. And as we all know, there are still over 1 million vacancies within this country. So people who want to have jobs have jobs. The other key point is top right, UK household savings ratio. And again, to bring you up to date, on the Bank of England figures last week, household deposits, i.e. savings, were £340 billion, which is some 23% ahead of where they were just before the pandemic started. So that sort of enforced saving that we all, those of us in work, endured during the pandemic is still there, 340 billion of it. It is being utilized, and that's quite clear when you look at other stats such as retail figures. So, as I say, in no way are we going to pretend that, it's all rosy out there, but actually there are a lot of positive points. The other chart I'll point to is the Purchasing Managers Indices, the PMI, and these are still expansionary. Manufacturing, no. Manufacturing is in decline. Sub 50 means going backwards. But overall, us being a services industry, again, we are in expansionary territory. So while it looks very gloomy, I say headlines, interest rates, inflation remaining stubbornly high, there are quite a lot of positive factors out there. On this second slide, I'm just going to remind you of the long-term outperformance of UK mid and small caps. And I promise you, we didn't sort of pinpoint 1996 as the time when this was going to look good. The chart looks very, very similar if you go back all the way to the 50s or 60s. So the yellow line here, we've got the FTSE 250 ex investment trust. As you can see, over most timeframes has produced some of the best equity returns in the world. You can very clearly see here what happened in the pandemic, and the FTSE 250, and very much likewise our Numis Smaller Companies Index, being more domestically much more domestically focused than the FTSE 100 and of course then the S&P 500. We take the brunt. We take the brunt when the UK is out of favour, and you can see that, as I say, very clearly the sharp decline in the pandemic, but then notably, the very strong rebound until end of 2021, inflation rearing its head, then Ukraine war, and you can see that actually the de-rating has been quite very stark. I wouldn't say quite, I would say very. So that takes me on to the next slide. Guess what? I'm going to talk to you about valuations. I mean, there simply isn't a commentator out there who doesn't say and agree that the UK market is cheap. It's cheap on pretty much every metric you look at. Here we show you the humble PE, and you can see FTSE 100 on 10 times. And us, as I said, our benchmark being the Numis Smaller Companies plus AIM Index, ex investment companies. Again, we're on 10 times for circa 8% median earnings growth. And we use the median figure here, and these are the stats that we look at weekly. But let's be clear, within our portfolio, despite the difficult backdrop in a lot of areas, we have companies that are growing significantly faster than that 8%. And guess what? The dividend yield, ex the non-pairs, of which there are quite a few in our index, almost 4%. If I turn to the next slide, I'm going to actually talk more about value and valuations within, well, both our index, but most importantly within our investment trust. But first of all, let me stand back and just describe briefly the investment philosophy whereby Katan and I run this fund. In fact, we run all our funds. So it sounds like a statement of the obvious, but what we believe in, and we'll show you a very long-term track record of why we believe this, is that attractively valued, high-quality stocks with positive momentum will generally, over time, outperform the market. So I'm going to drill down into those three factors: value, quality, and momentum. So the point is, it's not only what we believe, it's it's the mindset by which we invest in companies, but we actually track this. And so as we sit today, we have significant tilts within the portfolio to both value, to all three: value, quality, and momentum. If I start with value, the two key factors that we look at, the two key metrics that we look at are the humble PE, and I've shown you that, and our fund is more cheap than our index, and you saw the index on circa 10 times. But the other metric that we absolutely focus on, probably the most important metric that we follow, is free cash flow yield. So what we're focusing on is the cash that companies produce after all the normal costs. It is literally the free cash flow yield, which they thereby from which they can pay the dividends and increase capex, etc., etc. The index is on let's be clear, a very measly 2%. If I said to you that 3 to 4 is sort of fairly normal, I don't know what normal is anymore, but a normal number, and I am demonstrating to you, and these are historic numbers, by the way, and our companies are producing more cash every year. Our historic free cash flow yield of the overall components of our investment trust is almost 8%. I'm almost speechless. I don't know how to describe how indicative that is of value within the companies that we own. So that is value. Quality is the second factor that we focus on. And I always say this, I mean, there is not a fund manager alive. You'll never have met one who doesn't say that they look at quality, and they look at quality of management, and, you know, all these good things. And we, of course, do the same. But when we're talking about quality, again, we're talking about numbers, we're talking about metrics, we're talking about things we can measure. So for us, quality, in terms of the numbers you see in front of you, comes directly from the balance sheets. It comes from annual reports, and we look at a number of factors, but the one we put up here, and we didn't cherry pick it, it would look the same for several others, but we look on ROIC, or return on invested capital. You know, how much is each company making, how much return is each company making on the capital that they've invested. And as you can see, the index is a very healthy 10%, but the trust is circa 15% return on capital. And that is this number for us very rarely wavers. I mean, we just always focus on investing in high quality companies. And then thirdly, momentum. When we're talking about momentum, we're talking about two things. So we're talking about price momentum, because we like companies that are doing well, and therefore ideally their share prices are going up. But we also very much focus on earnings momentum. So how is a company doing, first and foremost, against its own internal forecast, and then how is a company doing against the forecasts that are out there from the analysts in the broader market. You can see here again, the index is seeing downgrades at the moment. As we know, life is very tough for certain companies in certain areas of the market, but you can see that our investment trust is actually net getting upgrades. So if I turn now, so please kind of, you know, bear that in mind when Ketan talks to you and takes you through the trust. But those are the three factors that we are looking to have in the portfolio. Ideally, you get all three in one stock, but what we're looking for is collectively that our investment trust has positive tilts or weights to value, quality, and momentum. Just touching on the fund itself, a little bit of kind of fund information. So I've mentioned our benchmark, which is a very broad one. Gearing, you can see we're circa, as we speak today, we're circa 9% geared. It says here the gearing range is well, 10% cashed up to 15% geared. But to be honest, over most of the last many years, we've been running this investment trust. We tend to have 10% as about the sort of cap. You don't want the gearing to be the tail that wags the dog in terms of performance. So 9% tells you we are bullish. We are bullish, and very largely that is about the valuations that I've been talking to you about. We're also cheap. Discount today is around about the 13% number. So you're buying, if you buy in today, you're buying all the assets that we own, or your proportion of them, at a 30% discount to the share prices. And then the portfolio yields, forward dividend yield, 3.3% forecast. We do not target dividends in this area of the market, in this fund. We really don't. You know, we're here for growth. Not surprisingly, you buy smaller companies so that hopefully they get larger and larger, and ideally and occasionally they get all the way up to the FTSE 100. But that's just a demonstration of the understanding of a lot of our companies that, you know, dividends are important to all of us, to you and to us and our investors. But also, as I say, we will happily own companies that don't pay dividends if they've got better use for the cash, if they're in sort of growth mode. And the one other point I would just make on that is that obviously during the pandemic, a lot of companies pulled their dividends, rightly, because they were protecting the balance sheet. But we carried on paying. We paid. The board took the decision very swiftly to pay out of reserves. That's what reserves are there for, and we've now rebuilt those reserves back up. Just touching on performance. So this brings you right up to date to the 31st of May. And here is a 10-year track record. I will say, I will be very honest here, 2022, especially the first half of 2022, with the inflation proving far worse than anyone's expectations, and definitely than ours. And then, of course, with the onset of the Ukraine war and the surge in many prices, but especially energy, we were wrong-footed at the start of the year, and we had a very poor start to the year, and that has affected these metrics. But you can see that over the 3, 5, 10 years, we are absolutely first quartile, and our aim is to get back there again. And with that, I'm going to hand over to Ketan.
Thank you, Georgina. Good morning, everyone. So just over the next few slides, I'm just going to run through what has and hasn't worked in the portfolio over the last 12 months or so, give you an idea of some of the changes that we've made to the portfolio as a result of that, and leave you with our current positioning across stocks and sector. But just to kick off in terms of how the portfolio has performed over the last year or so, and what has driven that performance. On this slide, you can see the contributors to performance on the left-hand side and the detractors from performance on the right-hand side. So just perhaps kicking off with the detractors on the right-hand side, and the largest detractor, as you can see here, is Future, which is a multimedia publishing company. So they have content which is for consumers, historically a very print-focused company, and has taken that content online to consumers. What's been really frustrating about the share price performance of Future is that actually throughout most of 2022, they actually didn't see any significant impact on their business in terms of consumers not visiting their sites, other companies advertising on their websites, which is where they generate a lot of their revenue. Yet the share price was caught up with all of the macro concerns that Georgina has alluded to during her section. And sadly, this was the case for lots of different sectors, be it in the media space, be it in the retail space as well, where we saw share prices impacted by macro concerns without it actually being fed through into the numbers of certain companies. And some companies are obviously more resilient than others. So Future was certainly caught up in that. They have had some downgrades to their forecasts in the last 12 months or so of about 15%. But as you can see, the share price performance here, falling over 60% during that period, is at odds with that earnings change. And as a result, the shares are incredibly attractively valued at the moment. So we continue to hold a position in the portfolio. In terms of the free cash flow yield, the company will generate almost 20% of its market cap in cash over the next 12 months, if forecasts are correct. So just to give you an idea of the valuation attractiveness of this company, and indeed many that we hold in the portfolio. One other I'll refer to as well is Hunting, which is an oil services firm, has large operations in the US and also across the world. And there's another one that, again, has just been caught up in macro concerns. So Hunting has actually produced very strong results. They've upgraded their guidance to the market a couple of times in the last 6 to 9 months or so. They're seeing very large order wins with some very interesting partnerships outside of the US. Yet the market is very much focused on the oil rig count in the US in particular, which has been falling very slowly over the last few months. But Hunting, in spite of that, have delivered very strong results. But as you can see, that has also led to a weak share price performance for Hunting. And I think certainly for Georgina and I, it's worth reflecting here that we continue to focus on the company's results rather than being swayed by what's going on in the macro. As Georgina said on the first slide, she talked to, really our focus is on the bottom up, the fundamentals of companies, understanding what they're producing and how they may be impacted by the wider macro, but absolutely focusing on the details of companies' results and holding on to those positions. So the likes of Future, looking at the results in the context of the share price performance, the likes of Hunting has been very important to us. Just a couple of others as well. Watches of Switzerland, which again has caught up in the retail concerns, and was another one which saw its share price fall dramatically last year. Recovered a little bit from the lows, but still remains down in the doldrums. We think, again, there's very interesting longer term case here. We've retained a large position in the portfolio. It's tapping into a very underpenetrated US market. The biggest item for them in terms of sales is Rolex watches. There continues to be very long waiting lists for these watches. There's still a very solid second-hand market as well, which is supporting values. And I think the market has come to see these watches as a store of value rather than trading them. And I think Watches of Switzerland is in exactly the right place. Very strong relationships with all of the key suppliers of luxury watches. Is being supported in its rollout of stores across the US and indeed across Europe. And we think there's a really interesting long-term growth story there. Just turning to some of the contributors to performance on the left-hand side, and you can see on the top is Bank of Georgia, and this is a premium listed company in the UK market, and the share price performance has clearly been very pleasing. And this company we've known for a very long time. It's consistently delivered strong results, and that's really been driven by a number of things. Firstly, the Georgian economy grew north of 10% last year, is forecast to grow north of 7% this year. Debt to GDP ratios below 40%, so very different to other developed economies. The banking market is dominated by Bank of Georgia and TBC, and they are benefiting from increased penetration across their products. They are amongst the most profitable banks probably listed in the UK market, and indeed have very strong capital buffers. So the regulator in Georgia actually follows the PRA and the FCA in terms of the UK, and ensures the capital ratios of the banks there are aligned with Western banks. They deliver very nice buybacks and dividends to shareholders as well, yet the stock remains incredibly attractively valued. So we tend to look at banks on their book value and where they're trading versus their book value. And Bank of Georgia is trading just below that currently, despite being an incredibly profitable bank and consistently delivering well ahead of market expectations. So that's been a very pleasing performer in the portfolio over the last 12 months, but we think that there's still plenty to go for as the Georgian economy continues to grow, and indeed the penetration of products they have to consumers in Georgia increases. Also just flag Ashtead Technology. So at the end of 2021, we invested in Ashtead Technology. It was an IPO at that time. It provides asset rental into the energy sector, so across oil and gas and also renewables. It's a company which we took a relatively small position in, as we tend to with IPOs. We do plenty of due diligence. We will meet with analysts who are covering the IPO. We'll meet with the management of companies, perhaps more than once if necessary. And analysts on the desk will produce their own models and look through companies' house data as far back as we can find it, and we'll take a view. But that said, we need to ensure the management are aligned with how they should be dealing with public markets and setting realistic expectations. And Ashtead Technology has been a wonderful example of that. They have delivered consistently above market expectations since they came to market. And as a result of that, we've grown our position in the portfolio. As you can see here, the relative weight, so that's the portfolio weight minus the index weight. So this it's become one of our larger holdings in the portfolio. And that has been led by the performance of the company in terms of its results and delivery from management. So a very strong balance sheet as well. And again, we think there is plenty to go for here. Just across all of these as well, I'll just flag some of the retailers. So I talked about Watches of Switzerland, and again, a company that have been impacted by wider macro concerns. But there are retailers that are still delivering, and the likes of Dunelm and Premier Foods in here. So I'm sure you're very familiar with Dunelm, and Premier Foods is a supplier of foods across supermarkets. The likes of Mr. Kipling would be one of its key brands. But I think we are blessed in the UK market that we do have some really high class retailers in the market, category killers in their own right, and continue to deliver despite the market backdrop and concerns over the UK consumer. Perhaps just moving on to the next slide in terms of some of the changes that have taken place in the portfolio. And I'll start with some of the example exits on the right-hand side. National Express, again, hopefully a brand you're familiar with. I'm sure you've all seen their coaches running up and down the motorways across the country. Actually, their largest exposure is US school bus. So the yellow school buses, they provide a service across the US. They had issues in terms of recruiting drivers and inflation, and couldn't deliver on contracts as a result of that. It's a company we felt just had a little bit too much debt, particularly in a high interest rate environment, so decided to exit that. Videndum, which produces camera systems and accessories, both into professional studios, but also for consumers. Again, a company we felt had a bit too much debt for the current environment and saw a slowdown in its consumer business. And again, we decided to exit that. Robert Walters, a staffing company, and we were concerned about the outlook for this company and thankfully exited this holding just before they had a large profit warning. So it was fortunate timing on that, but that's one we've exited. And then Brickability, which is a supplier of construction materials, including bricks, funnily enough, into the UK market. Again, was sold just on preferred opportunities elsewhere. I think we're fortunate in our index that we have. It's a very broad and diverse index. There are always plenty of very interesting opportunities coming our way, and not necessarily linked to what's going on in the UK economy or the wider economy, often forging their own paths. And I think we've found examples of that on the left-hand side. So Bodycote, which is a provider of heat treatment services to various industrial, so aerospace and defense, be generally industrial as well. And it's a company that we've known for a very long time. She came down into our index at the beginning of the year. It's consistently delivered very high operating margins. It's delivered very strong cash generation, has no debt on the balance sheet as well. And we purchased this after a very strong trading statement where they were trading ahead of market expectations and benefiting from a general uptick in industrial activity as a result of supply chains having issues in the last 12 months or so. A lot of that coming back, and they were certainly benefiting from that. Card Factory, which again, hopefully is another one you're familiar with. And again, a company we've known since IPO, had invested at IPO and then actually sold out on the company just expanding too quickly into too many different areas and again, taking on too much debt. They have had a change of management and have rehabilitated themselves in terms of the balance sheet is in much better shape. They're very focused on where they're investing, so making sure they're getting the most out of their existing store estate and closing unprofitable stores. And as a result of that, the company has been delivering ahead of market expectations, looks incredibly attractively valued when we're looking at the potential cash generation for this company as well over the next 12 to 18 months and beyond. And therefore, we've taken a position in Card Factory as well. Money Supermarket, perhaps another one you're familiar with, a comparison website which runs across different verticals, be it travel, money, energy. And I think they've been benefiting from the environment that we're sitting in. There is a lot of inflation there. People's bills are going up and people want to ensure they're getting the best deals they can. And Money Supermarket has been a key beneficiary of this, particularly in the travel sector as consumers have returned to traveling. They have benefited there. And then also there's the opportunity in energy going forward and insurance indeed as well. So a company that has delivered again ahead of market expectations, has no debt on the balance sheet as well, and provides a very nice dividend yield to shareholders. And then the final new addition is Rank Group, which is a provider of casino operator and bingo hall operator. So Mecca, Bingo, Grosvenor Casinos are their key brands in the market. And again, a company we've known for a very long time, were invested pre-pandemic. They were delivering again, well ahead of market expectations at that time. We then sold out, obviously, as we went through the pandemic, given the challenges on their business, having to close their venues. And the recovery probably took longer than expected to come through, but it's just started to come through this year. Their casinos are delivering well ahead of expectations, and the bingo halls are returning to pre-pandemic levels as well, slowly. So we've invested in there. There's also been a recent white paper around gambling as well, which should be very beneficial for them on a longer term basis, and we see significant upside to forecasts in the market for where they could get to in terms of profitability. Again, a very strong balance sheet as well, and very attractively valued. So you can see some interesting new additions to the portfolio across a variety of sectors. Some are household names, and just gives you a sense of the kind of quality that we have available to select from in this part of the market. Just turning to the next slide in terms of sectors. So as Georgina said, we're very much bottom-up stock pickers here. So this is a result of the underlying stock selection. So, for example, in electronic and electrical equipment, there'll be positions like Judges Scientific, Oxford Instruments, Morgan Advanced in there. In oil, the likes of Serica and Energean. That said, in the REIT space, we're not finding many attractive opportunities at the moment, just obviously with debt costs going up and discounts perhaps not as wide as we would have hoped, and perhaps in sectors that we're less keen on. Just on to my final slide. So this is just this top 10 positions. As you can see, we do take large position sizes in the portfolio. The relative position, the right-hand column is the key one here. And we can go up to plus or minus 5% in the portfolio, and that really gives you an idea of the conviction, and we do have significant conviction in our holdings, and you can see that reflected in the portfolio here. And as I mentioned, IPOs are important for us, and once they prove themselves, they will rise up the portfolio. So the likes of OSB was a company we invested in at IPO, Ashtead Technology as well, which I referred to earlier. And they will hopefully be part of our portfolios for a very long time to come. Average holding period is probably north of 3 years. That said, companies will remain in the portfolio for much longer than that if they continue to deliver. So with that, I'll hand back to Georgina just to wrap things up.
Thank you, Ketan. So last slide from us. We had a slide which showed sort of well, quite how long Ketan and I have been in this industry. But here we show you a 25-year track record of the JPMorgan UK Smaller Companies Investment Trust. And it's 25 years for a reason, because I have actually been running this fund astonishingly for that period of time. Well, the first thing I say is, if there's ever an argument for not being in a tracker, I think I like to think this is it. I didn't lie to you. We had well, clearly the market and us had a very torrid time at the start of 2022, and you can see that here. But overall, pretty impressive returns, if I do say so myself. And that's the end of our presentation. So we're now, I think, happy to take questions.
Great. Thank you very much indeed, Georgina and Ketan. So we've got some questions have already come in. For those watching, if you've got more questions, do continue to send them in as we start to look at the questions that we've got already. Georgina, Ketan, you can see that we have some already. So why don't we kick off with one that says free cash flow yield of nearly 8% in the trust is highly attractive. However, will those companies be able to maintain cash flow generations as we enter a nasty recession, possibly nasty recession?
Thank you, Ian. Yes, I saw that, and it's a very good question. And also, I think, Ketan, if we just take one question each at a time. So if I answer this one, what am I going to say is this? The two things I'm going to say is a nasty recession is actually not currently our backdrop for the next 12, 18 months. Earlier this year, we'd have said, and possibly we still do, that we won't even actually get into recession at all in the UK. Not that we're going to have stellar growth. And clearly things are moving apace with inflation remaining high, and obviously interest rates where they now are, and again, very likely, according to most economists, going higher from here, from the current 5%. However, I did talk about sort of you can see this chart in front of you. I've been running this fund for so long that I can remember other very poor times, and the most obvious one being the global financial crisis. Huge difference there. The very large issue for most companies, a lot of companies in the global financial crisis, was balance sheets. They had too much debt, in hindsight, and then clearly, financial crisis did cause an extremely unpleasant recession. So we're not expecting that anything like a recession like that. Balance sheets, and you can hopefully, you've seen and gathered, it's a very key focus for us. Again, you don't get to score well on our quality metric without it. But also, even in the global financial crisis, many of the companies that I was invested in then in this investment trust continued to grow, not to even remain static, let alone go backwards. They continue to grow. That's the beauty of smaller companies. If you're in the right niche and the niche is growing, you're growing with it and you're gaining market share, it's extremely possible. And indeed, we would say for a number of our companies, especially those within the top 10 that you've seen there, several of those within the top 10, that will continue to grow regardless. So, I mean, a great question, but I hopefully I've answered it for you.
Thank you, Georgina. So another question: how much have higher discount rates lowered your views of fair value in the portfolio?
That's another very good question. I think that's probably impacted high growth, non-profitable companies more, which is not an area that we do play in. That said, we do have high growth companies in there, but we will always invest in profitable companies that are producing cash. I think the issue we have is that the UK stock market, and that's across the market cap spectrum, has derated so significantly over the last few years, and they were trading at a 40%, 50% discount to the average over the long term. So whilst perhaps we won't get back to the valuations we may have seen in a lower interest rate environment, as you can see from that free cash flow yield of 8%, perhaps the correct number is not 3% anymore, but it's certainly not 8%. So I think we still see plenty of upside in the value of a lot of our holdings, and I think that will come through if we're getting those sorts of free cash flow yields being delivered, and a lot of that money is now being returned to shareholders as well in the form of dividends and share buybacks as well, which will continue to support the economy. M&A is still ongoing, and perhaps we'll touch upon it in detail later on, but that's also a sign that there is significant value out there. Private equity are seeing it, and other industrial companies and across sectors are seeing it. So I think that's definitely a sign that there is still plenty of value in the UK market. And as Georgina said at the beginning, the free cash flow yield of 8% for a small cap portfolio that is seeing upgrades with high quality metrics is pretty unprecedented.
Thank you. Another question here saying how many companies in the portfolio have lowered estimate for 2023? What has been the trend in overall earnings of the portfolio so far this year?
Okay, if I take this one, I showed you that slide showing momentum. Well, I showed you our investment philosophy, and as you saw, and I think that figure is a 6 month figure. So our portfolio overall has seen upgrades, whereas the index overall, not huge, obviously, but overall, and whereas the index has seen downgrades. Do we own stock? I mean, you heard, Robert Walters being an example where fortunately, we exited, pre the downgrades, and that is, it's not inevitable, but it's very likely. As I said, our the way we think and what we like is companies that are outperforming expectations. Having said that, do we still own some companies that have had downgrades? And yes, I mean, a very good example is one Ketan touched on, which, as you saw, did hurt us last year. The downgrades were actually this year, was Watches of Switzerland. Ketan gave you a sort of a flavour of how we think about this company. And I mean, very simplistically, I mean, he talked to you about the fact that, a very major outlet for Rolex. I mean, this is a sort of a semi-symbiotic relationship between the two, with multi-year waiting lists for people to buy those very, very, very expensive watches. Apologies for that. And this is now on, Ketan, correct me on this, I mean, we're on single-digit PE, and we must be, what are we, 8-9% free cash flow yield now for a company which, as far as, and the way we look at it is, this is how you play Rolex. And Rolex is never going to be quoted. It's got a very distinct status, but and you're buying basically away into Rolex on sub 10 times and almost 10% free cash flow yield. So small downgrades for the US, which has been slowing a little bit. It's a huge growth market for them, and we think it's absolutely temporary. Again, there's a place for that within the portfolio. So it's as I say, a lot of the time we will be exiting when companies are disappointing, but absolutely where we believe we understand the intrinsic worth of companies, we will not.
Great, thank you. There's a question here about Burford Capital, and looking to ask what the thinking was behind exiting it, because it presumably would have been a good performer had you stayed with it.
Apologies, yeah. So we should have clarified, I guess, on the slide. So this was on the top contributors and detractors slide. So on that slide, it actually refers to Burford as being not held. So this is not a stock we've held, but because it is part of our benchmark and went up a lot, as you can see, over the 12 months, by not owning it, it detracted from the fund's relative performance compared to the index. So just to clarify that one. So yes, sadly one we missed, but it's one we've looked at in the past. It's part of our benchmark, but I'd say not owning it because it went up a lot detracted from our performance in the portfolio.
Great, thank you. So there's a question here about the sort of macro outlook on household positivity and the savings ratio you looked at, you mentioned earlier. Could you give a little bit more colour on the positive outlook? Given that May saw record bank withdrawals as households tapped into savings.
Yes, absolutely, and I mean, I really mean this. That was another great question. So, what I hope we're making clear, I mean, it's perfectly obvious to all of us. It's very difficult out there for pretty much anyone. So the point is, here. So and again, I saw those figures. I can't remember, as you say, it was almost 5 billion withdrawn in the month of May. What's clear is that people are withdrawing some of their savings in order to, well, it may be to pay higher mortgage rates if you're one of the sort of circa quarter of households in the country that has a mortgage, but it is only a quarter that has a mortgage, or to to go on holiday. We know very clearly people are spending on holidays. We also know that people are spending retail. We know that people perforce have to spend more to buy their food. So it seems quite clear that a number of people are withdrawing some of their savings in order to, let's call it, maintain the level of living that they wish to. But that's what savings are there for. I mean, kind of in the same way that I touched on, for our investment trust, we build up reserves, dividend reserves, and in bad times, that's what you do. You draw down on them and pay them. So I think it's in no way surprising. I think it would be astonishing if people weren't drawing down on those. But the point that I was trying to emphasize, was that number is 340 billion. So, you know, there are a lot of savings out there to continue to draw down on. So if, like us, you do believe that inflation, although, you know, you can, you know, if you look at this chart, yes, you know, it's turned the corner, but as we all know, it's far too high and proving much more difficult to bring down than had been expected. But it is clear that it will be coming down. It seems very clear from all commentary, we're coming down more this year with just, I mean, well, as of what was it, yesterday or the day before, all of our energy prices are coming down, etc., etc. I'm sure you've had all those emails from your suppliers. You know, this one, you know, won't look quite as bad. So as I say, you know, all of this, you know, these are, and I did say this, you know, we look at this data on a minimum, you know, monthly basis, exactly these charts, and of course a whole lot more. You know, if we're wrong on any of these, we will be making changes to the portfolio. You know, that's how we think. As Ketan said, you know, we both said, you know, we are bottom up stock pickers, but absolutely you have to have your view on the economic outlook, and I think we've made ours clear. It's not as gloomy as well, some of you appear to be, but it absolutely isn't rosy.
Great. Georgina, Ketan, thank you so much for your excellent presentation, for answering those questions. We have had a lot of questions, and I'm afraid we've run out of time. Thank you to all of those of you who are tuning in and sending in questions, much appreciated. As mentioned earlier, we'll do our best to get to those questions and answer them anyway, and they will be published on the event page, you know, later on, well, shortly after this call. So thank you all very much indeed for taking the time to join us today, particularly Georgina, Ketan. If those of you who are watching would please stay on a little bit longer while we automatically direct you to a feedback page, so you can let us know how you found it. In that case, I'll draw this to a close. Thank you all very much.